Should be okay. All right, so thanks for having me. I want to thank the conference organizer, especially Peter, who I hope is feeling better, for giving me the opportunity to come here to give this paper. It's very much a work in progress, so I would really appreciate if you have any comments or suggestions. Okay, so as Mark mentioned earlier, so the first part of the paper is about coming up with an alternative earnings forecast model. Then we're going to feed those forecasts into a valuation model such as a residual income model to try to come up with a better estimate of cost of capital. This is joint work with Matthias van Dijk from Erasmus and Yinlei, who is at Chinese University of Hong Kong. So I'm going to focus on the earnings forecast model, but just to give you some background in terms of where we came from, so let me talk a little bit about measuring expected returns or cost of capital. Right, so expected return or cost of capital is a central concept to both finance and accounting. Right, we academic researchers, we require expected return estimates to test the trade-off between risk and returns, and or to study the impact of disclosure policy or corporate governance on cost of capital. They're also expected returns. They're also important for corporate managers in making capital budgeting or other corporate finance decisions, and they are widely used by investment practitioners in portfolio optimization, performance evaluation, stock attribution analysis, active risk budgeting, so on and so forth. Okay, so traditionally, we have been using average realized returns to proxy for ex-ante expected returns, right? But it is well known that realized returns can be a very noisy proxy of ex-ante expected returns. In particular, Elton, in his AFA presidential address, argued that information surprises may not cancel out over a period of empirical study. So as a result, realized returns or average realized returns can deviate significantly from ex-ante expected returns for a long period of time. You could also use, alternatively, you could also use a factor model such as the CAPM or APT model, or empirically motivated models such as the Farmer-French three-factor models to help you estimate cost of capital. The problem is that they're also based on realized returns. And also we know that they are notoriously imprecise. In fact, Farmer-French in their 97 paper, the whole point about that paper is that it is really hard to pin down the expected returns for industry portfolios using these factor models. Right, so given these problems, what do we do? In our view, there are two approaches, right? You could try to clean up the noise in realized returns, right? So it's easier to talk about that in the framework of the Campbell-Schiller type of decomposition, right? This is just an accounting identity. It basically says realized stock returns, by their very definition, are equal to expected stock returns plus news about future cash flows. That's what we call cash flow shocks, and also news about future expected returns. Those are discount rate shocks, right? So if you can somehow estimate those cash flow shocks or discount rate shock, which separate realized returns from expected returns, and if you can somehow adjust realized returns for the price impact of those shocks, then you can arrive at maybe a better estimate of expected returns. Right, that's in fact the approach that Matthias and I took in a separate paper, where we show that the spread in expected returns between small firms and big firms after the early 1980s is much higher than what the realized return spread between small firms and big firms suggests, precisely because, or largely because, small firms after the early 1980s experienced negative cash flow shocks, and the big firms experienced positive cash flow shocks which work against the expected returns. Well, you may say, okay, I really just don't want to deal with realized returns. Okay, then the alternative approach is to estimate expected returns directly from stock prices. Right, this is by inverting essentially a valuation model, right? You have price on the left-hand side, so if you somehow get an estimate or estimates of future cash flows or future earnings, then basically all you need to do is to back out the discount rate, which is what we call the implied cost of capital. Right, and so they are the internal rate of return that equate the discounted value of expected future cash flows, which are typically estimated using analyst forecast to today's stock price. So it is essentially the market discount rate. Okay, so the advantage of this approach of using the ICC, what we call to estimate expected return, is that it does not rely on realized returns. It comes from price directly. And also, it does not rely on any specific factor pricing models. Right, so the idea behind the ICC, or the cost of capital approach, is simple and intuitive appealing. Right, as a result, that's being applied by many papers in both finance and accounting. As I said here, the typical approach is to use analyst forecast as estimates for future cash flows in the valuation models. However, there is growing evidence suggesting that the cost of capital estimates that comes out of those analyst forecasts and also residual income model or valuation models are not as reliable as you would like them to be. In fact, many researchers, they look at the reliability of these ICC estimates based on analyst forecasts by relating them to realized returns. Right, so the idea is that if you go back to the Campbell-Schiller, again, this accounting identity, because the cash flow shocks and discount rate shocks, they should not be predictable based on the ex-ante expected return, which is available at the beginning of the period. So a reasonable estimate of expected returns should be positively correlated with realized stock returns. The problem is many researchers, including Peter's paper with Monahan, found that many of these ICC estimates based on analyst forecasts, they're negatively correlated with realized stock returns. Right, so so the consensus or the general conclusion from those papers is that, okay, these guys or these ICC estimates based on analyst forecasts are really not very reliable proxy for ex-ante expected returns, and they attribute this to the quality of to the poor quality of the analyst forecasts, which we know are biased. Okay, so what do we bring to the table, right? So in this paper, we essentially propose a new way of estimating firm-level earnings, or forecasting firm-level earnings. So we use a firm-level cross-sectional regressions to forecast individual firm-level earnings for the next 3 years. And then we feed those earnings forecasts into the residual income model, then back out the ICC. Right, so the advantage of using the cross-sectional model compared to the time series model that Mark talked about in his paper is that the cross-sectional model allows us to use the large cross-section of individual firm data, therefore to generate statistical power without imposing survivorship bias or survivorship requirement. Right, so in a previous test, with the exception of the random walk model, if you look at the time series test of earnings forecasting models, they tend to rely on fitting individual time series model to individual firms, or fitting time series model separately to individual firms. And in order to enhance power, they typically, the tests are restricted to firms with a long earnings history, right? So requiring 20 or 30 years earnings data is not, it's very common, right? So the problem is survivorship bias, right? Because the earnings behavior for these long-term survivors may not be representative. And also, if you really think about it, I mean, 20 or 30 years may be a long time in a firm's life, but regression estimate using or based on 20 or 30 observations are not very precise, right? So the cross-sectional model that we use here able to is allowing us to basically address these two issues, right? And so we can use the cross-sectional model to estimate or to forecast earnings for any firm with publicly traded equity and a limited number of simple accounting variables. So as a result, the cross-sectional approach allows us to estimate the ICC for much larger sample of firms over a much longer period of time, right? Because one concern about the analyst forecast or the ICC generated by analyst forecast is that the coverage is limited, right? Because the IBES data doesn't start until 1976, and the small firms or financially distressed firms, they are underrepresented by the IBES data. And also, even for the firm with IBES data, earnings forecast beyond the second year, third year, are often not available, right? So if your goal is to if your goal is to study some research question which require you to have a long time series of expected return estimates, or if you're interested in expected returns in small and distressed firms, the IBES-based ICC estimate are not going to be able to help you much, right? So for us, we simply require you to have, public traded equity data so that we have the price of market equity. Then, really a limited number of financial variables to forecast your earnings. So we can do that for a much larger sample of firms over a much longer period of time. In fact, just to give you some sense, we are able to calculate the implied cost of capital for over 100,000 firm year observations. Well, the number for the IBES based one, if you really stretch the IBES data, you can get to about 50,000. So it's about half of the size of our coverage. And the other advantage of our model is that we do not suffer the biases inherent in analyst earnings forecast. Okay, so I'm going to try to show you that our cross-sectional earnings forecasting model is very powerful in explaining or capturing the variation in future earnings performance across the firms, across individual firms, and more importantly, compared to analyst forecast, our model-based, cross-sectional model-based forecasts are comparable in terms of forecasting accuracy, but our model-based forecast has a much smaller level of bias and also a much higher level of earnings response coefficient in terms of stock market reaction. And I don't think I will have time, but I will focus on the earnings forecast part. But if I have some time, in the end, I will show you some of the ICC estimation results. And in fact, what we are able to find is that the ICC generated using the model-based forecast, cross-sectional model-based forecast, is positively and significantly related to realized stock returns for the next 3 years. While consistent with past studies, if you try to correlate realized returns with analyst-based ICC estimates, they are significantly negative, right? So by that, we think that our model-based ICC is a more reliable estimate of expected returns than those analyst-based one. And then I probably definitely won't have time for this, but we do have some new and neat results in terms of using our new ICC estimates to look at equity premium and some of the equity trading strategies. How is 1, 2, 3? So these are the earnings for each individual firm for the next 3 years. It's being regressed on a bunch of accounting variables. VIT is the market value of the firm, so it is total asset minus book equity plus market equity. We have total assets, book assets there, that's AIT. DIT is the dividend payment. DD is the dummy variable that is equal to 1 for non-dividend payers and 0 for dividend payers. We have lagged earnings. That's the most important variable because we all know earnings are persistent. A negative earnings dummy, and operating accruals. Right, so we estimate this cross-sectional model every year from 67 to 2005 using past 10 years of so essentially we're running pooled regressions using past 10 years of data, right? And then what we do is for each firm and in each year T, we use the right-hand side variable which are measured at the end of year T and the coefficient from the previous 10 years of pooled regression to forecast the earnings for the next 3 years. Right? This is to ensure that our earnings forecast are purely out of sample. In other words, the information you would need, both the coefficient as well as the right-hand side variables, independent variables, are known at the end of year T. Okay, so what's different from between this cross-sectional earnings model and the earnings model, cross-sectional model we have seen before, is that here we're estimating or we are forecasting dollar earnings. The reason we focus on dollar earnings is because to make them comparable with analyst earnings forecast, and also I think it's conventional in the cost of capital literature to plug the dollar earnings into the residual income model to estimate the discount rate, right? So, but that being said, we are aware of the potential econometric issues that could arise if you run level regression. So we windsorize the level variables, and we also check robustness by scaling the earnings using beginning book assets, market equity, sales, or net operating asset, and all results will go through, so they're robust. So these are the earnings regressions. These are the time series averages of the annual pooled cross-sectional regression coefficient as well as their time series t-stats. Given the time, I won't discuss individual coefficient, but if you just look at the R-square, what it says is that these earnings model, cross-sectional earnings model, given how simple they are remarkably powerful in terms of capturing the earnings performance, futures earnings performance across firms. The average R-square is about 87% for the one-year ahead regression, 81% for the 2-year ahead regression, and 77% for the 3-year ahead regressions. Okay. How much longer? Okay, I have a couple of minutes. Good. All right, so these are the table to give you basically the value-weighted average earnings forecast for the next 3 years from a model, and also side by side the IBIS analyst forecast. Right, so the difference in coverage is obvious, right? Because we can do in terms of the number of firms we can calculate analyst forecast starts with about 1,000 firms, go all the way up to around 4,000 firms towards the end of 90s and drops down to about 3,000. And for IBIS analyst forecast starts in 82. That's the first year we can calculate the 3-year ahead forecast, right? Either from IBIS directly or impute the 3-year ahead forecast using long-term forecast and 2-year ahead forecast. Okay, so so that's the takeaway from this table, and then let's compare our model forecast to analyst forecast. So I want to bring your attention to panel B and panel C here. Here we report the average bias, accuracy, as well as the earnings response coefficient for the common sample firms where we can obtain both analyst forecast as well as the cross-sectional model-based forecast. Right, so if you look at the bias of the IBIS forecast for the common sample, this is what we know, right? They are overly optimistic, and the bias increase with the forecasting horizon. right? For the model-based forecast, for the common sample, we also tend to overestimate the earnings, but the bias is much smaller. On average, it's about, I think, 20 to 40% of the bias of the analyst forecast. If you look at accuracy, then the picture is more balanced, right? So in fact, the analysts are slightly more accurate. But the difference in the accuracy between our forecast and the analyst forecast is much smaller comparing to the difference in the forecast bias. Right, and what we really want to emphasize is the ERC, right? So this measures market's reaction when the realized earning deviate from the forecast. So in our mind, a better forecast, or a forecast that is closer to market expectation, should allow you, so a better forecast should have a higher earnings response coefficient, because if you really are able to proxy or capture market expectation, then the stock price should react violently when the actual earnings deviate from the expectation, right? So if you look at the differences in ERC, for the 1 year ERC is 18% versus 10%, and the difference grows bigger when we go to the second year or the third year, right? So, in the sense that the stock market do react more strongly when the realized earnings deviate from our cross-sectional model versus deviating from the analyst forecast. And also, just going back to the question after Mark's talk about whether, which actual are we using. So here, when we measure bias, accuracy, or ERC, we're basically benchmarking model-based forecast against CompuStat, gap earnings, right? And then for the analyst forecast, we're benchmarking the forecast against the IBEX earnings. Okay, so the evidence from this table basically tells us, especially the ERC evidence in terms of market reaction when you deviate from the forecast, give us some confidence that our model is better at capturing market expectation in terms of future earnings performance at individual firm levels relative to IBEX forecast. Right? Then we fit those forecasts amount of time into the residual income model, and we estimate the cost of capital. And I'm going to skip this one. And in terms of reliability of ICC, right? So what we do is to correlate our cost of capital estimates with realized returns. Right, so if you look at the right panel here, you can see that this is what we have seen before in the study by Peter and Monahan. Also, other authors have shown that realized stock returns for the next 3 years are negatively correlated with IBEX-based ICC estimates. But for our ICC estimate based on the cross-sectional model is positively and significantly correlated with realized returns. And we also show that if you sort on ICC measure at the beginning of the year, you can make about 8% returns for the next 3 years, while for IBEX-based ICC forecast, they're negatively correlated with realized returns for the next 3 years. So let me just stop here, and if you're interested in the application in terms of equity premium and trading strategy, I'll be more than happy to talk to you during the break. Thank you.
Great. So, questions? Go ahead, Christian. Do you want to go up to the mic, and then we can take the question? No, if you go up to the mic, then we'll let Christian.
So the question I have is twofold. I mean, first of all, one of the things that we have to worry a little bit about if we go down this path using this approach is that because we're passing through the data kind of twice, one of the things that you have to worry about is when you use that is standard errors, right? Because you're basically using the data to sort of first build that model, and then you're using the ICC for something. And so let's say you want to do something like study the effect of cross-listing on the cost of capital, or something that we've done, for instance. You'd have to worry about the standard errors in that. So that's sort of a minor comment. The other thing that I was wondering that you could do in this is try to figure out whether this is really coming from your sample expansion or whether it is coming from Bootsy and I, for instance, in our cross-listing study, have also done what you're proposing here, which is to replace the analyst forecasts when missing or negative with an earnings-based forecast, sort of a mechanical forecast, because we were worried about the survivorship bias. And because we did international research, I think the issue is really also differences in coverage in various countries. And we had severe concerns that that would impact our study. So we've done that, and we similarly find that the sampling obviously increases quite a bit, and it makes actually, in some cases, the differences even starker because you're picking up some of the firms that don't have analysts tend to have a much higher cost of capital and all that. So, but it would be interesting for us to figure out, is it really that, is the effect coming mainly from the sample expansion, or is it mainly coming from the analyst firm? It would be easy to do. I mean, you could basically, do it on a constant sample and figure out how much is your model versus how much is the analyst.
The answer is both. We have done that to check, basically restrict our model to the sample firm where we have both, well, you basically can get analyst forecast now, right? And then we find that essentially in terms of the ERC accuracy bias as well as the sort of correlation of the ICC with realized returns, they are largely the same as what we have seen here. But what we also have done is to, this might get at your question, that is to actually include analyst forecasts as the right-hand side variable in the earnings regression, right? So what we do find is those analyst forecasts are significant in the earnings regression, the cross-sectional regression, but they don't really add much to the overall explanatory power and also the performance of the earnings forecast as well as the cost of capital estimates.
Yeah, one just sort of quick follow-up on given Mark's sort of paper. I mean, what you might even think about is also for the sample where you have both, sort of think about combining, where you say, for the next 2 years, I'm going to use the analyst forecast because they're pretty good on the short term. Yeah. And then for the long term out, where I know that the analysts are horribly biased, we're going to use the mechanical model and see how that's, whether that gives you sort of further bang for the buck.
Okay, I'm going to let Greg.
Thank you.
Two quick questions, I think. I've thought in this area a lot. If you're looking at expected returns, and that's what the goal of the paper is, then when you start thinking about earnings, you're really trying to capture what the market thinks the earnings were going to be.
Yeah.
And my question is, what is the appropriate way to measure whether or not I've captured what the market thinks the earnings of this firm is going to be?
Yeah, I mean, that's, so I agree. So in the sense that, we show you some evidence, okay, the accuracy, forecast accuracy between the two types of forecasts are similar, but we're less biased, right? But the concern is that, okay, you might have a forecast that's less biased and more accurate, but that doesn't necessarily mean you're closer to market expectation, right? That's why we look at the ERC, which to us is the more direct test of whether you're able to do a better job capturing market expectation, right? Because in our view, if the analyst forecast, for example, is closer to market expectation, then you should expect the stock market to react strongly when the realized earnings deviate from the analyst forecast, right? What we find is the opposite. What we find that stock price reaction is much stronger when the realized earnings deviate significantly from the cross-sectional model-based forecast.
One other quick follow-up point before my other quick question is be very careful about the dates when you're measuring those kinds of things I'm looking at, because that was the point of Peter and I's paper about bias and forecasts, was the way that those things change over time plays a huge role in your timing of when you measure variables and calculate all these things is drastically important.
I agree.
One other question, just because, I've thought about this for years as well. The 12-year fade out, thinking about that a little bit, because what we're really saying there is that when you fade out the G estimate for over the 12 years, you're saying that Google is going to look like every other company in that industry 12 years from now. And I think in many cases, that assumption there's an intuition behind it of economic rents go away. I think Vicki and I's paper talks about there are times when things persist. And there's also the issue of, we know that players come in and out of industries, so the 12-year fade-out may not necessarily be the appropriate route. Some of the simultaneous estimation approaches and things for getting a G that you could then plug back in might be something that could help you.
Yeah, I agree.
So that's just a comment.
Yeah, I mean, we are taking the sort of the standard approaching, Gephardt, Lee, and Swaminas, and that is assuming that the ROE after 30-year mean revert to industry median, right? But what we have done is, because our model, we can actually forecast earnings 5 years or 10 years out, right? So then that will sort of minimize this sort of mean reversion phase. And also, we have tried different horizons in terms of the terminal value, and it turns out they don't really matter as much. So I'm fairly confident, at least as far as what we're doing here, is robust to this 12-year fade out or other things.
Okay, thank you. Go ahead.
It's also related to the expected returns, because your study started saying that realized return is a noisy proxy for expected returns, but later on you compare your model performance based on realized returns. So it seems a little inconsistent.
Well, the difference is what I'm saying, arguing early on, is the level of average realized returns can be a noisy proxy for ex-ante expected returns. But still, if you look at that decomposition equation, it still says that as noisy as realized return is, you can still use it as a way or yardstick to judge whether you have a good expected return estimate or not by looking at the correlation. Right? So what we're arguing is the realized return is the sort of back proxy for the first moment, but in terms of the correlation, it will still give you an idea in terms of whether you get a good expected return estimate or not. So it's a difference between level versus correlation or covariance.